So what we're going to understand a little bit more is that what we call it understanding investment portfolio, and a couple of strategies to increase income, a couple of methods to decrease cost, and a couple of income optimization techniques. And then ultimately we'll do a role play as you go, because all of us, we can talk about it. Talking is free, but action is everything. So when we say something, we say always take an action. If it's wrong, which is fine, but what happens? You found out it's wrong faster than down the way. But making a decision ultimately will help you to kind of move that forward, right? So every decision wrong is like not the way of doing it. So either way, make a decision, right? Don't delay. So if you haven't talked to your CPA yet, make the phone call. And on the other side, if you go to Instagram and TikTok, there's always a write-off. But that's a good talking point, but to go not that far, right? And you just can't write up everything. So it's cool, but it has a limitation and once you kind of get in it. So with that note, we always say that as an investor in the commercial real estate, having just one strategy, it's tough. It is just tough. It's because it's great when the market goes on a certain way. If that turns, you gotta go. You have to optimize as well. So having one strategy is great, but with this strategy, you need points of optimization so you can optimize as you go. And then within the commercial real estate, it's one of the the risk that we have. It's not a liquid that once you get in a deal, it takes 3 to 5 years to get out. So your optimization point, it's not quite there. But then question is, as an investor, you need to have a portfolio that gives you time and ways to optimize, right? For that note, we always say that invest in multiple different ways, right? On the top left, everyone has an investment hypothesis, from I feel like investing to all the way I am looking for downside protection, or I'm looking for a cash flow, or I'm looking for something. But at least on the top left, spend some time and ask the question in 2025, how much you're going to potentially deploy, and what is the expectation of that capital that you're going to invest, right? In this particular case, I was thinking of me. My investment hypothesis was I had a W-2 and I was looking for financial freedom, which is I was looking for money that pays my bills. So the burden of I have to go to job, or if they fire me, I'm in a defensive posture, that I wanted to take it off the plate. That was mine, right? And on that note, I saw that timeline of it. We always say that, look, put some timing around the investment, do multiple things, and then figure out your niche, then settle on it. If you don't know your niche, deploy the money a little bit, chunk at a time as you go. Just like buying a stock, you need to buy different type of stock. And what you don't want to do is this. I grew up in oil and gas. I worked at Shell. My wife worked at Exxon. Almost 100% of Shell employee will believe that Exxon is a really good competition, right? So we should buy some Exxon. And then after we buy Shell and Exxon, okay, if you work in upstream, then you're going to buy another upstream company. Then what happens? My job, it's oil and gas. My 401k, it's oil and gas. My portfolio outside the 401k, a good chunk of oil and gas. And both husband and wife work in oil and gas. All of a sudden, under the name of I know so, my whole portfolio depends on oil and gas. It's interesting way to take a look at it. So you want to take it out and you say, look, I understand a certain asset class, but if I roll all the dice in, am I balancing my risk, or am I just honing in, understanding as long as the strategy goes, I'm okay with it, right? So point is, have a plan, start with the hypothesis, look at 2025 in a business plan, what you're trying to do, and also have exits as you kind of come through. Do some 3 years, do some 5 years, do some 10 years, whatever it is, do some cash flow, do some appreciation, do some new construction. Stay in a domain if you choose to, right? If you choose to stay in a multifamily, within the multifamily, you have some cash flow play, you have some appreciation play, you have some new construction play, you have some land development play. Within the domain, you can create that small variance, right? If you stay in a retail side, if you say, hey, look, you know what? I want to get steady. I'm looking to cut coupon. Go to triple net. It's a coupon cutting. It works. And yes, there's some risk associated with it. Once you understand the long-term risk, cut the coupon. And if you say, you know what, life is boring, coupon is great, but I want some excitement, do some new construction. It's a little more speculative, but it's fun. You get to see the whole thing built up. And so build your portfolio as you go. And if you already have a portfolio, put that on a schedule, and then you ask a question: am I oversized in one bucket? Do I need to optimize that? So this is a good time to kind of, as you have the holidays, to think about it a little bit more, so you can make choices as you go. Why we say that? Because market, if you ask me, we're at the bottom of the barrel cycle. It's gonna go sideways for another 6 or 8 months or so. And this is a tough time, right? If you were to sell. If you were to buy, it's also a great time, because on the commercial side, it's not a comp based, it is the cash flow based. So if we can make a deal happen in this tough market, that also means we had made some tough, good, strong choices to make the deal happen. And as the market gets better over time, you're going to ride the tide, right? It's not about being timing the market. It's not about, I got the best deal. It's all about siding with the market with good choices. So you want to ride with the market. The market goes up, you want to ride the market. If the market goes down, you don't want to go down that much. So you can kind of, you build your portfolio that way, right? So on that note, all of us will have two choices. This one-step call is typically for the passive investors. So you get to see what happens on the background, how sponsors, as we take a look at it, we give you behind the picture, right? So you have an option. We call it passive is not true passive. It's actively passive. You have to read, you have to understand, you have to hang out, and then you kind of go. And then other option is really active, right? Be one of us. If you choose to be, say, I'm going to own and operate, that's a different workflow versus I want to be passive. All of us, we came from the passive to the active side, depending on how life happened, right? On that note, right, I'll go through a couple of things. Just want to share on the right as a federal tax bracket, kind of change a little bit next year. I used the old one, but on the left-hand side, and our strategy is pretty simple. I mean, and how do you get there? It's a different case, but the strategy is really simple. You got to reduce the taxable income, increase the deduction, maximize the credit, right? And then you time the income and deductions, then restructure. I know we have some restructuring of the investment for the tax efficiency, and then ultimately, the way number 1 to 5 will work, number 6 and 7, right? I cannot get to number 1 to 5 unless number 6 and 7 happens. And it's sometimes it's how, sometimes it's who, right? I mean, can we be Bill? It's gonna take me 10 years to get there. But can Bill be me? Yeah, I mean, he's just so many of us, right? There's not that many variation to it. I always say I am unique to my life, or my life is unique to me, but I'm a data point. I'm a repetition in the grand scheme of thing, right? There's so many people walk the same path that a version of the path that I'm walking in terms of a taxation perspective. To Bill is that, right? Shirai is one of many, versus I think I'm unique, right? So have your working professional around you, and then you kind of go. So before I get to the second slide, I want to share something, right? This is the end of the year. End of the year, we get some of the phone calls for business owners, especially because you kind of settle down and figure that out. As we go through those problem solving, sometimes we get benefit of it. So I have one of my good friend, he has a business, his earning is great. And in this case, he's hitting 7 figures. He had the taxation issue. Last year, he was mad at me because I could not get any tax, any depreciation 100%. We gave a little less. I ended up, buying a car that meets the tax code to write that off. This year, he was like, I already got one. I don't have the money to spend. And we got into a different legal structuring that I'll talk about it. And that structuring will have some of the optimization, which is number 1. So we'll talk about it. So the point is, look at your income level and understand how much tax you're going to pay, and then ask the question, I'm going to spend the money anyways. Instead of spending the money that I have to do it again one more time, can I take the money and spend with another team who can position me such a way so next year I don't? Right, next year I have something else. So there's always, they cost money, but the way you take a look at it is how much tax I'm paying. Is my total tax is $20,000 hypothetically? Then we have a choice. Do I pay the $20,000 this year and then get ready to pay another 20,000 next year, or do I pay the 20,000 this year, not to the Uncle Sam, rather ABC legal firm, and they put me in a bucket. So next year I pay 5,000. or next year I pay less, right? That's the economic decision that we all got to make. We can't make it unless we know how much we're gonna go pay, and that's what we've been saying last month and a half, that call your CPA, look at your tax return last 2 years and this year, identify what the potential money we're going to spend with Uncle Sam, then redeploy that and do something else. All right. So quick thing to remember that this year, for anybody who went to depreciation route for multifamily, is 60%. Next year is going down to 40%. So do nothing, invest in multifamily one more time is there. Now, we all know the chatter. Um, we got a new president and he is bad for real estate, but we don't know whether the rule is going to be passed or not, and when does it pass and how does it pass, right? But for now, it is what it is. At this point, it's 60%. Moving forward, it's 40%. Okay. So the next one, this is where I'm in. I used that example before. I quickly glanced it down. This is a tale of same family 2 years, 2022 and 2023. Their income went up almost 196%. It's a working couple, married, filing jointly. The income went up from $300,000 to almost $600,000, with $265,000 improvement on their income. So the couple worked hard. But if you look at the very bottom, they took only their net home taking went up only 140%. So their income went up 186%. Their take home went up 141%. And what part was missing is the deduction. They planned on the deduction 2022, especially the qualified business income deduction went to zero. So hence they paid the price where they took on 40% less. So our goal is to, at least at a minimum, keep the proportion the same, if not improve the bar. Bill, you want to add the green line a little bit? How important is the deduction as we build our plan for taxable income before I go to the second slide?
Yeah, it's because a lot of the stuff, the more you take, the government thanks you very much, because the more you make, the more they take. And so it's what they call like marginal brackets or progressive brackets. The percentage of tax as you make more, the percentage gets higher, which does also mean those in the higher income tax brackets, deductions are more beneficial to them than for the lower. However, just because you're making more doesn't mean you may have to pay more, because there's so many different ways to structure it, different ways to structure your business, because not all businesses pay tax the same. You could have an LLC. The exact same LLC could be a sole proprietor, it could be a partnership, it could be a C corporation, it could be an S corporation. And so what ends up happening is it's kind of looking at like, okay, well, which one's best? Now, some people, they've also said, well, I should be an S corporation, right? And, just kind of ask, because I don't always know what people have been told. And I was like, well, why do you say that? They're like, well, that's the best one, saves the most tax. And it's like, not necessarily, but again, also sometimes, yeah, maybe we can do something. It'll save you $1,000 in tax. It's going to cost you about $4,000 or $5,000 in fees to run it, but yeah, I'll save you $1,000 in tax. So sometimes you got to take a zoom out and figure out, okay, what are you paying for? What are you getting? But so many times, like one of the benefits of the real estate, not only taking the losses, but many times the thing that you don't see on the tax return is the cash flow that doesn't flow through your income statement. That's not the same thing as tax free, but it's more of a tax preferred or tax deferred. And I know Shariah always laughs when I say this. Remember, 1 out of every 1 people die. So we want to defer, die. And the really nice thing is when you own the real estate, not in an IRA, not in your 401k, which are very good options, but if you own it outside of that, your spouse, when they inherit it and you're in a community property state and like you haven't done any special trusts or anything, it's like tax free to inherit it. They get to start all the depreciation all over. They get to start all the basis all over again. And so again, it's just continuing on and on. And then if that spouse passes, they pass it on to the kids. Again, you just kind of keep doing it over and over and over, hit the reset button.
Yep. Bill, I really appreciate it. Now, one thing, excuse the typo here. Number two, it's really true. Like different income level will require different kind of a tax optimization. So that's where it kind of comes in, right? What's the tax burden? Let that burden drive the decision where you go, right? Our tagline is go make that money, and then once you pay that one time the fee, second time you'll get optimized around it, right? In this particular scenario, if you take a look on the top, probably it's a working couple on the top line, so your salary plus bonus stayed the same, but their business income went up, right? So I'll get to this slide afterwards, and then what we want you to think about it again. Planning is important, and pre-planning is important for an exercise. You always need to kind of do an exercise, do one as you have time, with the holidays, right? And think a little long term. Sometime the long term will come in where we have to pay that fees or the amount that we owe, but then maybe add some more because that's going to set us up for future, right? Sometime we'll do investment today that doesn't quite benefit my tax, but that sets me up for 2 years down the way, 3 years down the way. If I don't do it today, if I do it next year, then it pushes back another 1 year out. So again, we got to have a little long-term view, and then you kind of go. And last one is not only how much you make, but also how much you keep, right? So going
And
down to
it
the second
actually goes
slide.
back to exactly what you said before, or right there about the next one, reducing your taxable income. Just you got to get a bigger horizon. That may not mean this year, but how do we start reducing your taxable income, not just to retirement, but through retirement?
100%. And I'll share a little bit more as I kind of go through. And our belief is that we all need to pay tax. We all should pay tax. That's the way we run the government. But at the same time, that may not be today. And going back to what Bill says, defer, defer, defer. Once I'm gone, it's gone. So we all pay tax, just not today. Let's pay the tax some other day, and we can create the value, right? So it's a little bit more a different way of taking a look at it, right? We do pay tax, and we do. We love to pay tax, thank God, but just not today. Maybe 5 years from now, 10 years from now, sometime in the future, right? All right, so let's look at that. How does that work? So one of the things I wanted to kind of introduce the concept is the staging. Staging really matters or influences the outcome. So the tagline, we all know Warren Buffett, right? But if you think it through and read him and see what he came about, everything else, Warren Buffett wasn't Warren Buffett till he bought Geico. It's like that fundamental. He's a smart investor, it's all this other good stuff, we get it. But he wasn't the Warren Buffett till he bought Geico. And that's because, as you know, it's insurance company. Insurance company is free money. At least you have cash for 9 months, and then after you do a payment, right? So you have 9 months of the income from somebody. Somebody's paying you 9 months. Then month number 10, you pay out. So you have cash on your hand without any cost. That much money. And with the insurance company, he had money, and then he went make the deal because he's a savvy investor. Now he got the economic power. Then he kind of went in. And behind the Geico was his professor, right? If you read his books, it's the network that he has, it's the staging that he had. Then one thing happened and it kind of came about, right? It's the same thing. We all talk about Bill Gates, but if you think about it, Bill Gates went to high school. There are 10 other Bill Gates, right? But the difference was Bill Gates' dad and Bill Gates' mom and his high school, especially Bill Gates' family, the circle that they hang out with, they are advanced family where they talked about the chips and the fabrication and the coding. He got a wing of it, and the staging really amplified what he has done. Same with Elon Musk, right? His mom, gold mine owner. He grew up in the circle. He's smart. I get it. Everybody gets it. But at some point, he grew up in that staging. The staging gave him an overview, and he kind of really amplified the whole thing. So if you look at that perspective, our investment, staging matters.